Would you like to build financial confidence in this turbulent world? That's right. Against a backdrop of global pandemics, market volatility, and political turmoil, you can have financial confidence, in this turbulent world. Not only that, along the way, you can raise your return, reduce your risk, and cut your cost. That's really good. I'm Rodney Schultz, and your financial education is my objective. We're going to pursue that objective today by taking a look at 3 key stock market questions and their answers. Let's hit the slide deck. 3 key stock market questions for today. First off, how much money does it take to get started investing? Second question, how much growth can I expect? And the third question is, what is the probability of finishing ahead? Okay, 3 key stock market questions, 3 short questions. The first and third question have short answers. The second question involves some examples, but it's still pretty brief. So how much money does it take to get started investing? Surprisingly, only $1. And that's via Charles Schwab. I'm not getting paid anything by Schwab, but it's just one of many competing places you can go to invest. So you're saying, well, if it's only $1 to get started, what is the cost? And surprisingly, if you go with an S&P 500 index fund, that is the 500 biggest companies in America, the cost for $1 is 2 cents per 100 years, or if you've got $100, 2 cents per year. I'm not advocating that you go in with just $1 or $100 to get started investing, but what you will see is that it doesn't take a lot of money to get started. And also, if you've got some cash set aside, say a substantial portion, a few $100,000, well, but you're unsure about doing something like investing in the stock market, you can tiptoe your way in with $1,000 or $10,000. So that's the first question. The second question is, how much can I expect this to grow? From my website, greatwealth.com. If you click on it or log into it and go up to the top menu bar and look for calculators. Okay, hover over it or single click on it and you'll get a drop down. There's a number of calculators. If you choose, say for example, the savings calculator, and you input $100 a month for 60 months, that's 5 years, annual interest rate, this is really return on investment. Don't think of it as interest, think of it as a volatile return on investment. But let's just say it averages 5.5%. You can see that at the end, if you enter those and hit the calc button down here, you'll get these figures here. Okay? So you can see if you invested $100 a month for 60 months, a total $6,000, the return on your investment would be $888. So you say, well, that's okay, but not great. What if we double that from 60 months to 120 months? Okay, here's 120 months, same $100, same 5.5%. Now we're starting to look at real returns. Okay, you'll have $12,000 invested, $3,950 in earnings. That's not bad. So now what if you get something closer to the average return on investment for the S&P 500, of say, let's just say 8%. The long-term average is about 10%, but let's just say you get 8 that takes inflation into account. Okay, 120 months, 100 a month. Hey, you've invested $12,000. You've got $18,000 at the end of 10 years. That's not bad. So now, moving on, let's just suppose you're an average American making $48,000 a year. Maybe you're a teacher with a few years experience. Maybe you're a lab tech, but you're making $48,000 a year. And let's just suppose you invest 10% of your gross income, or $400 per month, for 25 years. Let's say you start at age 25, you never get a raise, inflation is zero. What will it be when you are 50 years old? And you're going, well, I can't really afford 10%. Well, 10% really doesn't cost you that because of an employer match, which is mandated by law to some degree, and also the fact that if it's in a 401k, you're going to get tax benefits. So it's only going to cost you about $280 a month, or 7%, to get 10% saved. Okay, and then let's just suppose you have an average return on investment of 7.5%. The question is, what do you think it'll be in 25 years? This may surprise you, but when you hit that calc button and you're going $400 a month gross in, 300 months, 25 years, 7.5%, you've got $350,000, and it only cost you $120,000. That's starting to make some headway. So you say, well, this all sounds good. Well, if you go down here and you click on the charts, you'll get something really misleading. Yes, something misleading. You see this all over the place. Okay, and this calculator, it assumes a nice, smooth average all along here. Okay, in reality, it is not nice and smooth because the markets go up and down. You get some volatility. You can start out around here, and if you make that 7.5% return on average, you'll be somewhere around up here. Say somewhere around up here. Okay, but it is going to be a bumpy ride. That is guaranteed. How bumpy? Well, if I look at a simulation of the S&P 500, this is just an example, this gold line, of how bumpy it could be. One would expect it if you're in the S&P 500, okay? Now, the calculator gives you a nice, smooth, this blue line, okay? But in reality, your emotions, when you're setting at this point right here, you're saying, hey, I'm 160 months in, okay? 120 months is 10 years. Okay, for the last several years, I've been plugging away into this thing, and I'm no further ahead. I haven't gotten anywhere. You got to be patient, and you got to realize there'll be times like this, times like that, like that. You never know when you're going to get something more like this. So, you've got to be patient. You've got to also beware of the volatility. Don't get in something that's riskier or more volatile than your risk tolerance. In the game of investing, you have to look decades down the road. Things may be blurry at times. You may not know exactly where you're headed or feel like you're going off course, but you've got to look down the road. Now, depending on your volatility, it's kind of like being in an SUV that goes off-road and drifts Okay, sometimes even goes backwards. But if you hang with it and you've got a good strategy, you will continue to move down the road toward your financial goals. The amount you go off the road and how rough it gets depends on how volatile or risky your portfolio is. So you want to stay with a portfolio where you can tolerate the bumps, the inevitable bumps that you're going to hit. So you've got to stay looking down the road to get to your financial goals. Let's go back to the slide deck. This kind of volatility begs the question that comes next. And the third question with the short answer is very simple. What is the probability of finishing ahead for different time horizons if you simply buy and hold the S&P 500? If you have a one-day time horizon, that is, you buy today, you sell tomorrow, your chance of finishing behind is 50-50. If you have a one-year time horizon, you simply buy, wait a year, and then sell. You have between a 2 out of 3 and 3 out of 4 chance of ending up ahead with the S&P 500. And if you have a 5-year time horizon, you have between an 8.5 and 9 out of 10 chance of ending up ahead, not including inflation. If you include inflation, it's a little bit less. So to recap, first off, it takes minimal money to get started investing. Second, how much your investment grows depends on time and your return on investment. And third, the longer your time horizon, the more likely you'll end up ahead if you simply buy and hold the S&P 500. And also, beware of volatility. So you can find out more about all this from my book, Great Minds, Great Wealth, Great for Your 401k, How to Raise Your Return, Reduce Your Risk, and Cut Your Cost. We've discussed risk the last few minutes. It is chapter 3 of my book, and I start it out with a simple discussion of a couple of golfers and looking at their scores. The video course for this book, or based on this book, will be coming in the fall of 2020. You can find a book available from barnesandnoble.com, amazon.com, and iuniverse.com, my publisher. Some information to start with: greatwealth.com is about investment finance education and is not personal investment advice. Past performance is not indicative of future performance. And also keep in mind that investing has inherent risk and you invest at your own risk. Neither greatwealth.com nor its advertisers or sponsors are liable. Thank you for watching. Thank you for your time and interest and consideration. You may want to check out my book, Great Minds, Great Wealth, Great for Your 401k, my upcoming course that covers the book. And if you're in the Houston area and have $250,000 in investable assets or more, you may want to look up our sponsor, one of our sponsors, Schultz Financial. So with that said, you may be wondering, what will the next video be about? That video will be why you can expect stock markets to forever move forward. That's a pretty bold statement. But in short, we'll cover it in just a few minutes of time, why you can expect stock markets to forever move forward. Thanks again for your time and interest. Please have a super day.